2026 CRA tax changes rolling out for seniors filing returns. What retirees must prepare for now. Something significant is happening right now quietly inside Canada's tax system. And if you are a senior, a retiree, or someone approaching retirement, what the CRA is rolling out for the 2025 tax year, the return you are filing right now, in 2026 may affect how much you keep, how much you owe, and what government benefits you qualify for in the months ahead. This is not speculation. These are confirmed changes, real numbers, real policy shifts, and most Canadians filing their returns this season have not been told clearly enough. Not by their financial institution, not by the evening news, and in many cases, not even by the people helping them file. Here is what concerns me most. The consequences of getting this wrong are not abstract. They show up in your benefit payments. They show up in your assessment notice. They show up in your monthly income, often months after you could have done something about it. My name is Joseph. On this channel, we analyze Canadian pension policy, CRA regulations, and retirement income with the seriousness those subjects deserve. What I am going to walk you through today are the confirmed, verified changes that every Canadian senior needs to understand before that April 30th deadline arrives. Stay with me. The next 20 minutes could change how you approach this tax season and everyone that follows. To understand what is happening in 2026, we need to step back and look at what has been building quietly over the past 2 to 3 years. Canada's senior population is now larger than at any point in this country's history. Statistics Canada reports more than 7 million Canadians aged 65 and older. That number is growing. And the federal programs designed to support them, Old Age Security, the Guaranteed Income Supplement, are funded directly from general government revenues. At the same time, the CRA has been undergoing its own transformation. The agency has invested heavily in digital infrastructure, automated assessment systems, and cross-referencing of income data. What this means practically is that errors, omissions, and mismatches in your tax return are being caught with greater accuracy than ever before. And in 2026, several things have converged simultaneously. A landmark tax rate reduction, new CPP contribution ceilings, adjusted OAS payment amounts, a fundamental change to how paper tax returns are distributed, and tightening enforcement around income reporting for seniors. Each of these, on its own, is manageable. Together, for a senior navigating multiple income sources, they form a landscape that requires careful, informed attention. Let me walk you through each one. Change number 1. The tax rate cut that affects everyone. This is the most consequential broad change in 2026, and it directly benefits seniors. The Carney government lowered the bottom federal income tax rate to 14% from 15%, effective the beginning of July 2025. This means 2026 will be the first full calendar year in which the lower rate applies across the entire first bracket. The 2026 federal tax brackets, adjusted using a 2% inflation rate, are now structured as follows. Income up to $58,523 is taxed at 14%. Income from $58,524 to $117,045 is at 20.5%. Income from $117,046 to $181,440 at 26%. And income from $181,141 to $258,482 at 29%. For seniors with income in that first bracket, and many retirees fall precisely in that range, this represents a real reduction in federal tax owed. The reduction from 14.5% to 14% means that everyone earning taxable income benefits, even if only modestly. Over the course of a year, this can result in meaningful savings, especially for households already stretched by rising costs. Change number 2, the age amount tax credit for 2026. The age amount tax credit continues to play an important role in reducing tax pressure for older adults. For the 2026 tax year, the maximum age amount is set at $8,496, which can be claimed by qualifying Canadian seniors aged 65 or older. Here is the critical nuance. This is not a direct cash payment. It is a non-refundable tax credit that reduces federal tax owed. The eligible portion of the $8,396 amount, once determined based on income, is multiplied by the lowest federal tax rate to calculate the actual tax reduction. This means the real value of the credit is smaller than the headline figure, but still meaningful for seniors managing fixed incomes. And this credit phases out as your income rises. If your retirement income from CPP, OAS, RRIF withdrawals, and any other sources has grown in 2025, you may qualify for less of this credit than in prior years. Change number 3, CPP contribution ceilings have risen significantly. The first CPP contribution ceiling for 2026 is now $74,600, up from $71,300 in 2025. The second ceiling is $85,000, up from $81,200 in 2025. For working Canadians still contributing to CPP, including those who retired and returned to work, this means higher mandatory contributions. The CPP contribution rate for 2026 remains at 5.95% for employees and employers, but the estimated maximum contribution is $4,145, up from $4,034.10 in 2025. For retirees already receiving CPP, this directly affects the benefit amounts their working children and grandchildren will eventually receive. And it matters for understanding the post-retirement benefit, the additional CPP credit earned by those who continue working and contributing after beginning to draw their pension. CPP payments themselves are set to increase by 2% in January 2026, down from 2.6% in 2025 and 4.4% in 2024, a sign that inflation is cooling. Change number 4, OAS payments adjusted quarterly. For the January to March 2026 quarter, OAS benefits increased by 0.3%, capping a total rise of approximately 2% over the previous 12 months. This brings maximum monthly OAS amounts to approximately $742.31 for seniors aged 65 to 74 and $816.54 for those 75 and over. These are modest increases. And for seniors who depend on OAS as a core component of their monthly income, understanding exactly what they are entitled to and ensuring that entitlement is not reduced by a preventable filing error is essential. Change number 5, RRSP limit increases, TFSA unchanged. The dollar limit for contributing to a registered retirement savings plan is rising to $33,110 in 2026, up from $32,190 in 2025. The TFSA contribution limit for 2026 remains $7,000 unchanged because the contribution cap adjusts in $500 increments and inflation has not yet risen enough to reach $7,500. For near retirees still in the accumulation phase, the RRSP increase is a meaningful opportunity. For those already converted to RRIFs, what matters now is not contribution room, but the accuracy of withdrawal reporting. Change number 6, paper tax returns, no longer mailed automatically. This change is operational, but its consequences for seniors are significant and it has not received the attention it deserves. The CRA will no longer automatically mail paper tax returns. Beginning January 20, 2026, Canadians who rely on paper filing must call the agency or go online to order a copy of the income tax package for the 2025 tax year. The agency noted it will take up to 10 business days for forms to arrive by mail. The default mailed kit no longer includes several low-use federal and provincial schedules. Removed schedules include Schedule 3 for capital gains and losses, Schedule 6 for the Canada Workers' Benefit, Schedule 9 for donations and gifts, and Schedule 12 for the multi-generational home renovation tax credit. Those who need these schedules must obtain them separately. For seniors who have filed paper returns for decades who rely on the package arriving in the mail as their annual signal to begin filing, this is a material disruption. If you have not received your package, it is not an error. It is the new policy. And if you wait to receive something that is no longer coming automatically, you may find yourself uncomfortably close to the April 30th deadline. Let me be specific about who is most directly in the path of these changes. If you are between 65 and 75, drawing from a RRIF, and receiving both CPP and OAS, you are navigating the most complex intersection of these rules simultaneously. Your income sources are multiplying, and CRA's automated systems are specifically calibrated to cross-reference them. If you are a lower-income senior depending primarily on OAS and the Guaranteed Income Supplement, the paper return change matters for you more than almost anyone else. GIS eligibility is recalculated every year based on your prior year's return. A delayed or inaccurate filing can trigger a reduction or interruption in GIS payments. That is a direct threat to the financial stability of some of the most vulnerable Canadians in the country. If you are approaching retirement between 60 and 64, the rules being applied now are the rules you will live under in your first years of retirement. Understanding them before you begin drawing is significantly less costly than discovering them through a reassessment notice. And if you are a family member helping a parent or grandparent navigate their taxes, the operational change around paper returns is something you need to know. Seniors who file independently without guidance are statistically more likely to encounter these disruptions without warning. Let me put realistic dollar figures around what we have covered. Consider a retired Canadian, age 70, receiving approximately $8,000 in annual CPP, $8,900 in OAS, reflecting the new 2026 rates, and drawing $25,000 from a RRIF. Their total reported income for 2025 is approximately $41,900. At that income level, they fall comfortably within the first federal tax bracket. With the rate now at 14% rather than 15%, their federal tax on that income decreases by roughly 1%. On $41,900, that represents approximately $419 in annual savings. Not dramatic but real, and compounding positively with the age amount credit. Now consider a couple where one spouse has a defined benefit pension of $22,000 per year, in addition to CPP and OAS, bringing their combined declared income close to $80,000. Pension income splitting, if properly executed, allows up to 50% of eligible pension income to be allocated to the lower income spouse. Depending on the income difference between the two spouses, this could reduce the household's overall federal tax burden by several $1,000s annually. But this requires completing Form T-2032, the joint election to split pension income accurately, on both returns, in the same filing year. It does not happen automatically. It must be elected deliberately. And consider a senior whose 2025 income from all sources combined approaches or crosses the OAS clawback threshold of approximately $90,997. For every dollar above that threshold, 15 cents of OAS is recovered through their return. On $5,000 above the threshold, that is $750 in OAS recovery. On $15,000 above $2,250. These are not negligible amounts for someone on a fixed retirement income. It is worth asking why these particular changes are arriving together in 2026. The tax rate reduction reflects a deliberate political commitment from the Carney government, a broad measure designed to provide relief to all Canadian taxpayers, including seniors in lower and middle income brackets. Finance Canada projected maximum tax savings of $840 per couple with two incomes from this measure, though independent analysis from the Parliamentary Budget Office suggested average savings closer to $750 for a two-income couple with a child. The CPP ceiling increases reflect the ongoing implementation of the enhanced CPP, a multi-year reform designed to improve retirement income adequacy for future generations. The trade-off is higher contributions now, in exchange for higher benefits later. The shift away from automatic paper return distribution reflects the CRA's broader digitization strategy. The agency has also implemented mandatory multi-factor authentication for CRA accounts, updated XML specifications for electronic filing of information returns, and launched new online services, all part of a significant modernization of tax administration infrastructure. The underlying rationale is efficiency, faster processing, fewer errors, quicker refunds. But the implementation timeline and communication around these changes has not always matched the pace at which seniors and vulnerable filers are expected to adapt. Tax professionals and financial planners working with retirees have flagged consistent concerns about the communication gap surrounding this year's changes. The elimination of automatic paper return mailing has drawn particular criticism from seniors advocacy organizations who argue that the roughly 7% of Canadians who still file on paper are disproportionately older adults, many of whom do not have reliable internet access, do not use online banking, and have limited capacity to navigate CRA's digital systems. Pension policy analysts have continued to note that the OAS clawback threshold, while indexed to inflation, does not adequately reflect the income reality of middle-income retirees with index-defined benefit pensions. Each year, the income of many modest retirees edges incrementally closer to that threshold, not because they are wealthy, but because their pensions are designed to keep pace with living costs. The refundable tax credit for personal support workers worth 5% of eligible earnings to a maximum of $1,100 available for the 2026 to 2030 tax years has been welcomed by those in the home care sector, where many workers support aging Canadians. But advocates note that the caregivers of seniors are only one part of the equation. The seniors receiving that care also need informed support in navigating their own financial obligations. The overall assessment from the retirement income planning community is that 2026 presents a genuinely improved tax environment for most seniors, but that improvement can only be captured by those who file accurately, on time, and with full awareness of the tools available to them. Let me move to what matters most, what you can actually do right now before the April 30th deadline. Step 1. Obtain your tax forms if you file on paper. If you rely on paper filing, do not wait. The package is no longer coming automatically. You must call the CRA at 1-855-330-3305 with your social insurance number or access forms at canada.ca. Allow up to 10 business days for mail delivery. Start this process today. Step 2. Compile every income source from 2025. CPP, OAS, RRIF withdrawals, defined benefit pension payments, investment income, rental income, any government support payments received. Cross-reference each slip you receive against your records. Do not assume slips arrived correctly or completely. Step 3. Check where your total 2025 income lands relative to key thresholds. If your net income approached or exceeded $90,997, calculate how much of your OAS may be subject to recovery. If your income began to reduce your age amount credit, the phase-out starts around $42,130. Understand what that means for your tax owing. Step 4. Execute pension income splitting deliberately, if you are eligible. This requires Form T.032 to be completed and reflected accurately on both your return and your spouse's return simultaneously. It is not automatic. It must be elected every year. If your situation involves eligible pension income and a lower income spouse, this single step may represent the largest single tax saving available to you in 2026. Step 5. Verify your GIS status if you are a lower income senior. If your 2025 income included any one-time amounts in inheritance, a capital gain, a larger RRIF withdrawal, your GIS entitlement for the following benefit period could be affected. In certain circumstances, you may be able to apply for GIS based on current year income rather than the prior year, but you must know to ask Service Canada for this option. Step 6. Set up or verify your CRA My Account and direct deposit. The CRA's new Manage Balance service within My Account allows taxpayers with tax debts of $1,000 or more to set up a repayment plan entirely online. Electronic filing combined with direct deposit can produce refunds in as little as 8 business days. For seniors expecting a refund, this is a meaningful difference compared to waiting several weeks for a check. Step 7. Consider professional assistance if your situation warrants it. Multiple income sources, pension income splitting, income near a clawback threshold, capital gains from asset sales, any of these factors increase the complexity of your return and the value of informed guidance. Free tax clinics are available in many communities for seniors who meet income criteria. Looking ahead, the direction of CRA policy and senior tax administration in Canada is clear: increasing digitization, increasing automation, and for those who are prepared, an increasingly navigable system with genuinely improved benefits for lower and middle income earners. The 14% bottom bracket rate, now fully in effect for a complete year, represents a real improvement in the after-tax income position of millions of Canadian seniors. OAS is being adjusted quarterly, CPP payments are indexed, and the broader federal benefit architecture continues to be calibrated to inflation, though at a more moderate pace as inflation itself cools. What remains a legitimate concern among pension policy researchers and seniors advocates alike is the administrative accessibility of these programs. A tax system that offers genuine benefits but buries them behind digital requirements, eliminated paper schedules, and complex eligibility rules does not fully serve the population it is intended to help. The conversations currently underway in federal policy circles around RRIF, minimum withdrawal rates, OAS clawback thresholds, and the long-term sustainability of GIS for a growing low-income senior population will shape the retirement income environment for the next decade. The outcomes of those conversations are not yet determined. What is determined right now is the deadline. April 30th is fixed. The rules are in place, and the seniors who will benefit most from the 2026 tax changes are those who understand those rules clearly enough to claim every dollar they are entitled to. Let me bring this back to what matters most. In 2026, Canadian seniors are filing returns in a genuinely changed tax environment. The bottom federal rate is lower, CPP ceilings are higher, OAS payments have been adjusted, the age amount credit sits at $8,396, and paper returns are no longer arriving in your mailbox automatically. These changes, taken together, can work in your favor, or they can catch you off guard. The difference is not luck. The difference is information. The CRA is not your adversary, but it operates according to rules that are, in many cases, more complex than they need to be for the people they affect most directly. Your best protection is accurate, current information, and your best investment right now is the time spent understanding your own situation before that April deadline arrives. If this analysis has been valuable to you, and I genuinely hope it has, I want to ask you to do 3 things. Subscribe to this channel if you have not already. We publish serious, in-depth analysis of Canadian pension policy, government benefits, and retirement income on a consistent basis. The kind of information that does not always surface in daily news cycles, but that directly affects the financial security of millions of Canadians. Share this video with someone navigating their retirement taxes this season, a parent, a sibling, a colleague, a neighbor. The information gap we discussed today is real. Sharing credible, verified analysis is one of the most practical ways to help close it. And leave a comment below. Tell me what questions you have. Tell me what part of your 2026 tax situation you are uncertain about. Those comments inform the topics we cover next. This is Joseph. Stay informed, stay prepared, and we will continue this conversation in the next video.